Australians openly embrace economic self-destruction. Martin North, John Adams, in the interest of the people. Hello, John.
Hello, sir.
Good to see you back in the studio again after a few days away. We've had the budget, of course, and we're going to talk about that tonight.
We are. Martin, I started this journey, and we've talked about this a few times. All I have ever wanted to do was to help my country and to help my community so that by the time my children are adults, they're going to have a decent country to embrace. And the unfortunate thing is that what happened last week, so we're recording on Sunday, so last Tuesday when the budget was handed down, it was a suicide note. And the reality is that Australians are openly allowing Parliament to bury the country in enormous amounts of debt. And we are basically going down a direction that we can never return. One of the important points that really captured my mind during the week, before we get into some of the detail of the budget, is that Michael Yander from the ABC, he put out a tweet, and let's put that tweet up on the screen. He basically said that when the ABC published stories about the budget, stories about individual budget measures which would impact individual voters, they got a lot of online traffic. Any article about the big picture, people are not interested. Well, the big picture matters, and that's what we're going to talk about today, because the big picture is extremely ugly, and a lot of Australians have a complete misconception about what the big picture is, because I think it's all about COVID-19. But once you actually go through the actual numbers of the budget, it has nothing to do with COVID-19, and it has everything to do with what I would argue protecting vested interests, i.e. the banks in the household debt bubble, as well as political management, a whole host of constituencies that have to be massaged in the lead up to the next federal election.
Well, I have to say, John, that my reaction is a bit like yours, which is that nobody really wants to think about that big picture. Everybody wants to dive down into little bits of spending here and there, and maybe that's because people can see that more clearly. But the big picture stuff is really, really critical, right? Because essentially the future of Australia has just effectively been smashed by what's happened, right? And yet people don't seem to be reacting to it.
Yes. We did a show, I think, last October after last year's budget was handed down, because it wasn't handed down in May. It was handed down in October because of COVID-19. And the amount of debt that we were racking up in that budget, we did a show, said Goodbye Australia, 1788 to 2020. This budget digs the hole even deeper compared to what we did, or the show that we did in terms of last year. Now, before we get into some of the specifics of the budget, the key point that people need to understand is, what is the economic philosophy of this budget? It's modern monetary theory. And we've done several shows on this. Some of our audience thinks that MMT is a good thing. I don't think it's a good thing. We did a show back in 2018 called The Matters of Monetary Theory, and we explained what that theory is all about. Now, the key essence of MMT is that you're using the budget fiscal policy to target a predetermined level of unemployment. And that is precisely what this budget sets out to do. So let's put slide 2 on the screen. So this is coming from the government's own budget overview website. More people are in work than ever before, and unemployment is on course to settle below 5% for just the second time in almost 50 years. Now, we have an article from the Financial Review, so let's actually put that on the screen. This article by John Keogh at the AFR, which was about a week before the budget, says that the Reserve Bank of Australia, supported by the Treasury, basically wanted the budget to push unemployment to below 5%. So that is what that is the objective of the budget, to spend as much money as possible to get unemployment below 5%. And as we just said in the previous quote, the budget says that they're going to do this for the second time in almost 50 years. Well, when was the last time that happened? That happened under the Howard government when unemployment in 2007 got down to 3.9%. Now, if you think about how do you get unemployment low from a supply side of the economy, it's about sort of making the economy more productive. And if you make the economy more productive, businesses can employ more people. During the Howard government, there was a lot of reform, structural reform, microeconomic reform. There was things around tax. There was things around industrial relations. There was things around ports, infrastructure, etc. That actually expanded the supply side of the economy. That actually made it more attractive to employ more people, and that is what drove unemployment down to 3.9%. In this time around, there is no structural reform. There is nothing to do with industrial relations. And I should say, while it is going to be very highly controversial with some elements of our audience, work choices was a critical factor to driving unemployment down to 3.9% prior to the 2007 election. So we have no structural reform around deregulation, around industrial relations, around making the economy more productive. And I've had some economists in the last week say, where is the national productivity agenda? Well, there is no national productivity agenda. So if there's no structural reform, how do you drive unemployment below 5%? You have to spend like a drunken sailor, and you have to finance that either through borrowing from the private sector, or you've got to rely on your central bank to print money infinitum, so that you can finance these ever large deficits to get to 5%. Now, the critical aspect of this is, and prior to the end of March, and we did sort of suggest that unemployment was going to go up with the end of Keeper and Seeker. So far, we will have to see what the end of Keeper and Seeker actually have for the economy. But come what may, the political test now for the budget is unemployment less than 5%. And if it doesn't do so, that's going to be a failure for the government. So if we go forward and they're struggling to get to 5%, dare I say that all they're going to do is just ramp up spending to even higher levels than what they've outlined in last week's budget.
And there's a couple of interesting points there, John. The first is that that level of unemployment is based on a certain measure of unemployment. It's the official measure, which basically means working an hour a week. And so my expectation is that many of the jobs which will be created, and there will some be which will be created, will be low-paying, not very attractive jobs in some ways. There will be a significant growth in service jobs, particularly aged care and healthcare, for example, where, of course, there's been a lot of growth. The question I've got is, you can grow the jobs and you can drive the unemployment down, but that doesn't actually create more momentum in the economy. It doesn't actually create more value in the economy. So whilst unemployment might be an interesting measure, it's not really a very good measure of anything really relevant to the future momentum in the economy, is it?
Look, so you make an excellent point, Martin. So if driving, so what generates wealth? It's about creating value. So that should be the focus of economic policy, not necessarily driving unemployment like below 5%. So the question has to be, well, why are they obsessed with this 5% unemployment target? Now, in our last show where we talked about the amount of debt that the federal government and the state and territory governments are going to rack up over 5 financial years, I made the point that the stimulus related to COVID-19 was about the banks, and it was about protecting this household debt bubble. Now, I think a bulk of our audience accepted that premise. There was one comment I recall where someone said that all we do is blame the banks, and there is no legitimacy for blaming the banks. But but I'm not going to accept that criticism. The question, so again, people need to understand. A couple of years ago, I was in an office in federal parliament by an MP who said those in the elite elements of the bureaucracy understand what we've been talking about this household debt bubble. They understand the risks, and they want plausible deniability. So they know that if this collapsed on their watch, their credibility is basically gone, and millions of Australians are going to be pushed into all forms of extreme destitution. So it's all about trying to protect the banks and to protect this debt bubble. And that's why I think there's an obsession with driving unemployment low, because it's all about ensuring that people can generate enough cash flow to meet their debt servicing obligations. And that's what I think is the real name of the game. But they're not going to come out and say it like that. Because I should say, we've had recessions in the past, we've had depressions in the past. I've never seen so explicitly this MMT statement that we're going to spend huge amounts of money in order to get... Now, governments will typically say we want to drive unemployment low. I've never seen in Australian history, and I'm happy to be corrected, where a specific number was selected and said, this is the test of economic policy.
But MMT, turn the conversation to MMT. MMT starts with that premise that actually the number one objective is to give people jobs, invest in jobs, make more jobs, right? So it is following the MMT doctrine, right? The other point to make is that, and Guy Debelle made this point a couple of weeks ago, is that if in the process of that you have to keep interest rates really low and house prices go through the roof, that's not a problem. So he basically said, I'm prioritizing low unemployment over controlling house prices or interest rate monetary policy, right? So everything is fixated now on low numbers of unemployed.
Yes. The other key point is that for people to understand the difference between Keynesian economics and MMT, John Maynard Keynes said that spend big in a recession, but when the economy starts to rebound, start to run surpluses to pay back the debt. So Keynes's position was, over the course of the economic cycle, you should have a neutral position on the amount of public sector debt the government has. MMT basically says there is no need to pay back the debt. And again, when we did the show back in 2018, we showed clips of a lecture from Professor Bill Mitchell from the University of Newcastle, where he said that governments who obsess about sound public finance are completely misguided about how government accounting works and how government works from a financing point of view, and that as long as the deficits are containable, you can run deficits for a very, very long time, and there is no issue. Now, the problem with Professor Bill Mitchell is that he has given an explanation. He has been asked about hyperinflation. What happens when you print so much money to finance these deficits and people lose confidence in the currency, and then you start to see Germany 1923, Zimbabwe 2008, and Venezuela. He has given a very specific explanation of what happened in these historical episodes, which is not historically correct. So MMT people completely discount the risk of hyperinflation, and they basically, and I think the whole basis is flawed. Now, the reason why this budget is so dangerous is that there is no surplus over the forward estimates. There is no prospect of ever balancing the books under Frydenberg. And I saw one comment that said that there is a hope, and again, it's a hope, it's not a guarantee, that we will somehow balance the budget by 2031. So we're going to run deficits for a decade at very large amounts of money. And we are hoping that our creditors are basically going to just continue to lend us money, and there'll be no repercussions. I mean, that is just so irresponsible. It's irresponsible for households who rack up huge amounts of mortgage debt, and it's responsible for a federal government to do so to a country like Australia.
And there's a big risk, of course, because there is an assumption in the budget that interest rates will stay low for a long period of time. I would argue that their interest rate forecast is way, way too low in the out years, right? Conveniently, right? But if rates do start to go up, then the cost of that debt will go up. And that's going to put extra pressure on the budget in the out years too.
Indeed, indeed. Now, before we get into the issues of spending, debt, deficit, and the interest, but look, there was one image that I thought was quite pertinent. So let's actually put this on the screen. It clearly shows that, look, particularly the ALP, they have jumped on in terms of this escalating debt and said, well, when we had a much small amount of public sector debt, you called us irresponsible, and now everything is okay because it's done by the coalition. I mean, I worked for the coalition. I helped get the coalition into power. I didn't do this because I thought they were going to rack up this amount of debt. Had I known that, I never would have gone to work in federal parliament in 2012-13 because I, consistent with the philosophy of John Howard, thought that the coalition was actually going to reduce public sector debt and actually to re-establish sound finance in Canberra. But clearly Morrison and Frydenberg have abandoned any prospect of what people have been led to believe the Liberal Party was all about.
And just go back 2 years, right? It was 2 years ago that this is before COVID, they basically declared that they would be in surplus. Do you remember that?
Yes.
Right? So this has changed dramatically quickly. Now, of course, the alibi is COVID, right? And, you and I have argued as to whether the investment they made through COVID was appropriate. Probably wasn't. A lot of money that was spent didn't need to be spent. But the argument pre-budget was the economy is now on the mend, everything's going really, really well, and yet we're spending even more. No one's explained to me satisfactorily why you need to spend all this money other than to try and get unemployment down. So I think unemployment now is the new target because it's basically deflecting from all the other stuff.
What I mean, the thing is, look, so when you say it's deflecting from the other stuff, I mean, but on the other hand, we do have an issue with the ability to manage debt. And obviously your mortgage stress data and your rental stress data clearly says that people are struggling to survive on a cash flow basis. So there was extraordinary measures put in place last year, from bank holidays to all sorts of supports, rent moratoriums around rent increases, etc. A lot of those measures are you cannot do those forever. So at some point those measures have to come off, and yet the RBA, in trying to promote financial stability, they have to find a way to keep this debt bubble in check. And the only way they can do that is to improve the cash flow of those households with debt. And that's why I think their obsession with unemployment, that's what's driving it.
Right, but remember, there's no real expectation of wages growth over the next few years. Right? So for those people in work, the expectation is that if you manage to get wages growth to track roughly with inflation, in other words, no real increase at all, you're going to be doing really well. So cash flow pressure on households, even in that budget, is still there.
Of course. Look, I don't think it's going to go away. But if unemployment stays persistently high, and they keeper and seeker, those with a mortgage. That's when you're going to start to see the rise in delinquencies and defaults, and that's going to have issues in vis-a-vis financial stability in terms of the banks. Now, very interesting you talk about COVID-19. So let's actually put this next slide on the screen. This is from Sky News. They asked about budget priorities. They said, should we cut the debt or should we provide support for the pandemic? And 80% of the viewers said support for the pandemic. Now, again, the key revelation of the show is most of the spending has nothing to do with COVID-19. I mean, you could argue there is a bit of it, but a lot of it has nothing to do with COVID. So I would argue that this question that posed by Sky News is based on a false premise. And the way we'll actually prove that is actually going through some of the specific budget numbers.
Okay.
The thing I said to myself is, well, we had a budget released for this current financial year, not 2021, in October last year. Now we have a budget for 21-22 that was released last week. So I said to myself, well, let's look at these 4 financial years that the budget had put together last year versus what came out last week. And actually, we'll see what the changes of the level of spending is to give us a feel for what has actually happened in terms of new spending commitments or perhaps a reduction in spending. So let's actually put the next slide on the screen. Now, what I can reveal to the audience is that we have the current financial year where spending is expected to be $16.6 billion less than what was suggested last October. But moving forward from July of this year onwards, we're looking at an extra $66.7 billion of new spending relative to last year. So remember, last year in October was the pandemic budget. So this was supposed to account for COVID-19 and all of the issues that were related to COVID.
And worst case, because at that time the unemployment was meant to be higher, everything was going to be worse.
Yes.
Right?
Yes. So it's worst case scenario, October last year, and yet last week last week it was revealed over these 3 new financial years. They've incurred an extra $66.7 billion from July this year through to June 2024. Now, in terms of the lower spending of $16.6 billion for this financial year, so because the recession is less severe than what they had estimated, they need to pay for less stimulus in the current financial year. So that's why the amount of spending is lower. But now, so we have a big financial commitment around vaccines. Some of that expenditure will be incurred this financial year. Some of that will be incurred after July, so it'll be into next financial year. So you could say that this $24.8 billion for next financial year of extra spending, some of that may be about vaccine rollout, but the bulk of this spending had everything to do with individual budget measures, whether it's aged care, NDIS, the Women's Economic Security Package. I think there was some additional spending around defence, mental health. There was some other health measures. All of these massive. I think there was also some more money for the Indigenous community, etc. So there was a number of massive spending commitments, and these were structural spending commitments. So these were not just temporary one-off increases. I mean, aged care, which was in more than $10 billion. I mean, that was a permanent increase in spending. That is what this spending is all about. Nothing to do with COVID-19. It's all about. Now, I guess the question is, why have they brought all this spending forward? Is this necessary, or is this due to an upcoming election? In the case of aged care, I mean, obviously we had a Royal Commission into neglect in the aged care sector. There has been some argument that there needs to be more funding, more places, more training, and more staff. So that perhaps is the case for some additional resources in that particular sector. But I should say, one observation that one economist has made to me on the phone is the Morrison government is very good at throwing money without actually reforming anything to make things better. So you can invest in a sector, but if you're going to make that money work, you need to actually change things so that you get a better bang for your buck. And they haven't done that. They just throw money at the wall, hoping that throwing money is actually going to change the situation. And in Canberra, it never does.
No. And on those 2 big areas, both age and NDIS, the fact is most of the people working in the sector would say that just throwing money the way they're doing it is not going to actually get to where it needs to get to. And if you look at the Royal Commission into aged care, there were some really big structural things that needed to change. None of that in the budget.
Yeah, absolutely. So even though some people may think that spending more money on some of these areas is a good thing, I would argue that without those structural reforms to actually make the aged care system more effective, a lot of this is going to be wasted money without those important reforms. Now, let's go on to our next slide in terms of...
Just one point, John, before you do. There's also another little line in there. There's several $1 billion, which is not specified in terms of what they're going to spend it on, right? But it's actually, stuff they know about, but they're not going to tell us about yet, right? another sign, I think, of an election cycle just coming around the corner.
Yes. I mean, that is a standard technique of Canberra. In an election year, you'll have a undefined bucket of money that will be set aside to make some announcements during the election campaign.
Yep.
So
it's there. So expect the election within the next 12 months.
Exactly. Now let's move on to the next slide about the change in terms of the annual deficit. Yep. So this next slide is looking at what the deficit was last budget in October of 2020 and what they put together last week. So what we can see is for this financial year, the deficit is supposed to be better to the tune of about 52.7 billion. So last year they said the deficit was going to be about $200 billion for this financial year. It's going to be about 166 billion. So something around that area. We see that there's going to be for next financial year a slight improvement in the deficit. But then in 2022, 23, 24, over those 2 years, the deficit is going to be worse to the tune of $24 billion. And that, again, has nothing to do with COVID-19. That has everything to do with this additional spending, which is about driving unemployment low and actually winning an election. So again, it's about ensuring this mammoth household debt bubble doesn't collapse, and it's all about sort of keeping Labor out of power. That's what the name of the game is, and yet none of that really came through the commentary because people really haven't sort of thought through, well, what is these numbers actually saying?
And I just want to underscore again that we're looking here at the annual movements, right? The net annual movements. Of course, the gross debt is the sum of these movements plus all the debt that's already passed.
Correct.
Right?
Yes.
And the total number is now close to $1 trillion at the end of the cycle, right?
Yes. So again, what we're saying here in terms of the deficit is that on an annual basis, have you spent more money than how much more have you spent than the revenue have you come in? So what we're saying is that in this financial year and next financial year, the deficit is going to be smaller than what was forecasted last October. But in 22, 23, 24, the deficit is going to be worse. Now,
one other quick point, John. It's also worth just bearing in mind that as part of this cycle, there are those stage 3 tax cuts, which are in the budget, right? The top end tax cuts,
yes,
which is worth a large amount. I think it's something like 130 billion over the cycle, right? That's in the budget.
Yes.
So from a policy perspective, they're still giving top-end tax earners a break.
Yes. And again, look, it makes perfect sense with an election.
Yep.
But also, it makes perfect sense when you think about debt serviceability because and we've mentioned this on several shows, the debt distribution of the household debt bubble is very similar to what Ireland went through pre-GFC, which is the higher the income, the higher the debt.
Yep.
So if those people with large incomes and large debts get a tax cut, you improve their cash flow to meet their debt servicing obligations.
Yeah, and absolutely. And my mortgage stress numbers are still saying that we have a huge number of more affluent people right up against it. So they need their tax cuts.
Indeed. Now, these numbers, Martin, are predicated on a range of very optimistic assumptions.
Yep.
And if those assumptions don't happen, then these deficit numbers are going to be worse. So even though people think that this financial year, next financial year, the deficit's going to be slightly better, it may not be if these assumptions don't happen. So what are the key assumptions that sort of came to my mind? One is they're assuming a full vaccine rollout by the end of the year.
Although they're not clear whether it's 1 or 2 jabs, right? They've wobbled around post the announcement on Tuesday on that.
Yes. Obviously, no major outbreaks with COVID-19. So obviously, out of nowhere, for example, from mid-March through to now, India just sort of has blown up. So no one at the beginning of the year expected India to go through what they're going through now. Yep. So obviously, if we did have a major outbreak of COVID-19, that's a huge game changer that, again, financially we're not prepared for, let alone politically or psychologically. obviously, international borders will open mid 2022. Now, if we go to the next slide, there is some very rosy assumptions about consumption and non-mining investment. So they're assuming that we're going to see next financial year a major uplift in the growth of consumption, and then it's going to settle down in 22, 23. And then when you look at non-mining investment, so that's fallen quite sharply this year, and they're expecting a modest growth next year, and then really ramping up in 22, 23. So again, if people spend less, or if people are not aggressive at the shops, if the non-mining sector doesn't really pick up in full steam, these budget numbers are going to be a lot worse than what they think. Now, the only saving grace, and to be honest, look, I do think there is a get out of jail card in the short term for the budget, and that is iron ore prices. Yeah. So the budget assumes, so we're roughly, I think in the last few months, we've been at 200 tons.
Above 200 and 220 at one stage, yeah.
220. The budget is assuming that there'll be a sharp fall in iron ore prices over the next 12 months. Oh. And I think from memory, the budget papers talk about a price around $55 a ton. Now, to be honest, I don't think that's going to happen, because if you have stagflation, you're going to see commodity prices across the board be high and remain high. So if commodity prices stay high over the next 12 months, that will be the only get a jail card for the government. There will be a lot more revenue from the mining sector. Even if the non-mining sector is weak, that will give them some additional flexibility. But knowing how Canberra works, rather than actually using that money to reduce the deficit and get these finances under control, dare I say, there'll be people motivated to just spend the money if there is more income going through. So that is the only get out of jail card. And I think that's important to call out, because I do think they're too pessimistic on iron ore prices for the next 12 to 24 months.
Well, I think that could be deliberate in terms of sort of fudging the numbers. There's another rule of thumb, and that is for every $10 movement, US dollar movement in the iron ore price, it translates to $2 billion to the bottom line. So these are big numbers, right?
Yes.
If it moves substantially up or down. So, and by the way, they used a similar forecasting method last year and the year before, and of course the iron ore's been way above where they thought it was going to be.
Yeah.
So it's not very accurate.
Yes. Now, in terms of gross debt, so in our last show we talked a little bit about gross debt. So what I can say is that according to the budget numbers, so if we look at last year's budget last October for June 2024, what was the gross debt, and how does that gross debt number change based on the numbers from last week? By June 2024, gross debt will be lower by only $4 billion. Yep. So even though there's all this big news about things are going much better than expected, that we're going to have a much smaller deficit this financial year than what we thought, because they have racked up a massive amount of spending going forward, gross debt is only going to be lower by $4 billion. So the debt burden, it really hasn't changed in terms of what we're going to expect by June 2024, and that was the sort of that was sort of the rough number that we were talking about last time. And again, June 2024, the budget is forecasting gross debt for the federal government to be north of $1.1 trillion, right. With no plan for a surplus and no plan to ever pay this debt back.
Remember, that's just the federal budget. We've also got all the state stuff too, right?
That's right.
Because we'd already previously calculated that net had been spent across the states and feds at more than $1 trillion.
Yes.
So the total debt burden for Australia is a lot higher than the 1.1 trillion that they're now talking about.
Correct. Now, what is the key vulnerability? And you talked about it earlier in this conversation. It is interest rates.
Yep.
So a couple of points. The first one is, let's actually put up the next slide. It is very interesting that over 6 financial years, the budget is assuming from July 2019 to June 2025, the federal government will spend $113 billion on interest. Now, when you have a government with no debt, like we did in 2007 under John Howard, you don't have to pay money on interest, and then that money can be invested in all sorts of worthy causes throughout the country. But we're now going to be wasting 113 billion over 6 years, and again, that number wasn't presented to the public, and people don't understand that as this debt continues to grow, by financial year 23-24, the interest bill is roughly going to be about $20 billion a year. That is, by historical standards for Australia, that is a staggering amount of interest that we have to pay. And just think of what we could have done if we actually ran a tight ship and we didn't have so much debt and we didn't have to pay so much interest.
No, absolutely, John. And it's a frightening amount of money at low rates. But of course, the forward yield curve is indicating significantly higher rates ahead.
Aha. Well, so the interest rate is a very interesting thing. So let's put up the next slide, because the next slide basically assumes that in fiscal year 1920, the government paid an effective annual interest rate of about 2.45%. They're expecting that from July 2022 and beyond, the interest rate is roughly going to be 1.8%. Now, that is a historically low number. If that number does not hold, and here's where governments typically get into trouble. If that number doesn't hold, what does that mean? It means that the interest cost, so we said roughly 20 billion a year. If these interest rates were to double or triple, which is not out of the realm given the historical rate of interest that the government has had to pay, the interest cost could balloon to 40 billion, 60 billion dollars, and then that's when the rating agencies are going to say, we don't think you're good for the money. You're going to lose the AAA credit rating, and also things can unravel very quickly. So these effective annual interest rates are basically a very dangerous set of arrangements that the government has assumed, because, dare I say, I think the interest costs, even though we said over 6 financial years it's going to be 113 billion on interest costs, I think that number is going to be much higher, because they have basically assumed very unrealistic low interest rates over the next few years ahead.
I expect the only point to make there, John, is that all central banks in the Western economies have the same problem. And so the combined worry about the impact of rising rates will force those central banks to try and keep rates as low as they possibly can for as long as they possibly can, right? So they'll be trying to fight the market, because the market's already saying rates are going to go higher, the risks look like that. So that's going to put a lot of contention on the financial system and on the financial markets over this period.
Well, we are seeing, for example, in the United States over the last week, we saw the CPI came out with an annualized 4.2%. Yep. We've seen a massive increase in producer prices in America. So with all this money printing, we are seeing some early signs of inflation coming through the official statistics.
No, but it's not real inflation, it's just transitory. Don't worry, John, it'll go away again, according to the Fed.
But here's the key point, Martin. Their argument is that they had to print a huge amount because of COVID-19, and that will lead to a short one-term hit to inflation, and things will calm down. If debt is so out of control that interest rates can never rise, otherwise we're going to have the biggest depression in world history, the money printing will have to increase rapidly, yep. And that will guarantee that inflation is not transitory. It's going to be permanent. It's going to be entrenched, and it's going to be much higher than what we have been experiencing on an official basis over the last couple of years.
And interestingly, of course, there is an argument to say, well, if you allow inflation to go high, then in real terms the debt gets squeezed in terms of its relative value to the future, right? So on one hand, they want to keep interest rates really low because of the interest rate costs. On the other hand, they quite like inflation to come in and reduce the real exposure of the debt into the future. Kind of both.
Yes. Now, the interesting question from an economic point of view is, so we've established there is no plan to pay back the debt.
Yep.
But in order for government finances to remain intact, they have to at least pay the interest. Because if they don't pay the interest, well, then the whole thing will come crashing down. So how are they going to pay the interest? Now, I found this really interesting quote from John Keogh at the AFR. So let's actually put this on the screen because this crystallizes a lot of stuff. Frydenberg's argument is that with interest rates historically low, economic growth will generate enough tax revenue to cover the cost of servicing interest payments over the next decade.
Interest payments? That's an interest-only loan then.
Exactly. So what they're effectively saying here is that we're going to generate income to just pay the interest. That is the quintessential interest-only loan.
Yep.
Now, in this case, it's a variable interest-only loan. It is not fixed. But again, if anyone thinks that there's going to be a plan to pay back the debt, there is no appetite in the RBA, in the Treasury, in Parliament to pay back the debt. The debt is only going to pile up, and our children and our grandchildren are basically stuffed. And the only way this game of musical chairs continue is if they can continue to serve this interest-only loan. And we've obviously seen in the mortgage context that there's been a number of people with interest-only loans who get caught out because their circumstances change and they don't have enough contingency to adjust for those circumstances. That's what this government has set this country up for.
Right, and just recall, before COVID, right, RBA and APRA through the Council of Financial Regulators pushed down on interest-only lending for mortgages because of the enhanced risks of financial instability caused by them. And yet now we're following precisely the same recipe with massive amounts of debt, just worrying about servicing the interest and not worrying about repaying the debt.
Thing is, look, what can we say for a bunch of hypocrites? Interest-only loans are too risky for households to do, but why don't we put the government on an interest-only loan? I mean, the whole thing just it reeks of hypocrisy.
Yep.
And again, without wanting to get into trouble on defamation laws, this country is swamped with what I call cash for comment economists. There are a number of professional economists who are regularly on TV who do not explain what's going on to the public. And I dare say they are put on TV because they precisely won't tell the public what's going on because the powers that be don't want this sort of information out there. But again, what is the title of the show? Australians openly embrace economic suicide. We are killing ourselves in real time and we are allowing the elite to do it to us. And that is something I just cannot fathom why we are allowing, why is the Australian people basically, allowing the country to go into this direction.
Well, but you see, I think, John, that's exactly the point. That's why in the budget there are all these little seed pods of investments on various social schemes. And, they can say, well, we've helped that area and that area and that area over there, right? And so superficially, it looks as though the budget's doing good things, right? And they'll spend a lot of time talking about that stuff, and of course the Economist will also do the same. But no one is talking about the real issue here, which is what we've explored tonight. No one wants to explore that. No one wants to talk about the interest-only loan that basically the government has now set ourselves up for. That's the true story, but that is also a story that no one wants to talk about.
Yeah. So Martin, in summary, Frydenberg, over the last two budgets, the two most horrendous budgets in peacetime. Again, so we have spent more money during World War II, but in peacetime, last year and this year was the biggest amount on any basis that we've ever spent. Martin, we are going down on a path of extreme debt. We are building up massive vulnerabilities, and the biggest vulnerability is about these low interest rates and the amount of interest that we may pay if interest rates were to skyrocket. There are no contingencies if the worst were to happen, with either economic growth being too low and we don't generate enough income to pay the interest, or if interest rates were to go up through a range of mechanisms. So it could be that official interest rates go up. It could be that yield curve control on the 3-year bond was to cease. It could be that rising inflation may lead to the bond market selling off the bonds, driving interest rates higher. There's a range of reasons why, or the end of quantitative easing, if that were to ever happen. There's a range of things that could happen that could drive these interest rates costs up. And at that point, if the interest costs go up, and we can't meet these interest repayments, just like a mortgage, if you've got an interest-only loan and you can't pay the interest, your financial solvency comes into real question. And then just like how banks get twitchy about mortgage holders, our creditors, which is increasingly not just Australians but foreign sources, they're going to get twitchy about our capacity to pay. And then we are in strife. And I have to say, and you said this to me on the phone, and I just want to sort of be transparent with the audience. You said, but everyone else is in the same boat, and that is true. And there are some governments, like the government of Japan, which is in a worse fiscal position than Australia. But to be honest, and let me be selfish for 1 second, I don't care about any other country. I don't care about my country, because I'm here, my wife's here, my kids are here, and my responsibility to my children is to ensure that the country that I was given as a young adult, I'm going to give them a better situation when they become adults. And my daughter's 6, so we've got 12 years until she turns 18, and we are on track for her to have to be honest, a terrible adulthood because of the decisions that Frydenberg has made, both last budget and this budget.
Yeah, John, and I want to make just one other point, which is the amount of money that's being invested, right, is not actually going to give us any long-term legacy in terms of future value, right? There is an argument that you could have invested a large amount of money on changing the nature of our economy for the good into the future. But none of that is in this budget. So it's a big number, it's a risky number, but it's not actually delivering long-term value to Australia either. And that's another negative to this whole budget, in my view.
Absolutely.
John, I appreciate your time today. Very important conversation. I'm sure we'll pick it up again. Folks, you heard it here. Interest-only loans are now the thing in Australia. Martin North, John Adams, in the interest of the people. We'll see you next time.